What's up, everybody? Adobe stock seems to keep falling down, just can't seem to catch a break. We've looked at this company a couple times. I think last time we looked at it, it was about $340-ish a share, I want to say. In that video, I think I said under $300, I would start being interested in Adobe stock. And as we see, we're right at a 52-week low, down 27% on the year. Over 5 years, doesn't look any better, down almost 34%. The stock has been more than cut in half from the peak it hit in 2021. I don't own this stock. The lower it gets, the more attractive it becomes to me. So we're going to take a look once again. And as always, if you get value out of the video, subscribe to the channel. If you want access to my Google Sheets template and add-on to make spreadsheets like this for whatever stock you're looking at, then consider following me on Patreon. Link to that will be down below. Now, let's get into it. I've done a couple videos talking about Adobe before, and I think most of you are probably familiar with the company. At their core, they're a software business. They have tons of apps that are market leaders in their space: Photoshop, Premiere, After Effects. This creative suite is what I consider to be the core of the company. I've used Adobe products for many years. I consider myself pretty proficient with a lot of the software they have here. And I will say, as a user, over the years, I have often been frustrated with Adobe. Something like After Effects, for example, this is the industry standard for visual effects. It's incredibly powerful software. You can do a ton with it, but man, there are a ton of bugs, and it feels to me they aren't really motivated to fix them because there isn't really a second product, a After Effects alternative. Everything else was far enough behind that, it seems Adobe didn't really have to worry about competition. And you could say similar things about some of their other products like Photoshop, for example. Canva, to me, really is not competition to Photoshop. Canva's like Photoshop Lite. People who are real creative professionals, who are photographers or who use Photoshop in their work every day, you can't get by without this application. Now, I will say that some of the things that Figma is doing are pretty cool, but still, Adobe is the market leader. Everyone is used to using these programs, and it's really hard to dethrone that. On top of that, the revenue that Adobe is getting here, it's mostly recurring revenue. People have subscriptions. Adobe just collects their check every single month. Revenue goes up and to the right. If you look over time here, this is a beautiful graph just going straight up. And while revenue has been increasing, they've been improving their margins as well. This is a sign of a dominant business. They're becoming more efficient as they scale out. More money is just flowing to the bottom line, and it's incredibly profitable. Recently, while growing, they've also turned to focus on returning value to shareholders in the form of buying back stock. The share count's coming down. There's close to no net debt. So this business is really checking a lot of the boxes of what we want to see in a company we invest in. So why is the stock price down so much? What's wrong with the business? And is it cheap? Is there an opportunity here? So I think there's two main reasons why the price is down. The first one I've talked about in previous videos on Adobe. It's, fear around AI. There's concerns with all the Gen AI photo and video applications now that there simply might just be less demand for Adobe's products. But also there's fear that, now that AI has made software development so much cheaper, that maybe Adobe's moat as a software as a service company is not quite as wide, not quite as impenetrable as it was before. And you have some increased competition from Canva and Figma. Now, all in all, I don't quite buy into this narrative so much. I think the fear around AI is overdone. You could equally argue that Adobe is going to be the beneficiary of many of the advances in AI. They've partnered with Google and other Gen AI models that they're bringing into and incorporating into their applications. As a user, I can tell you that Adobe Firefly, which is like their sort of Gen AI product, it used to be pretty bad. And now that they say, designs using top AI models, Google, OpenAI, Runway, and more, now, it's gotten quite a bit better. Adobe's own models aren't the best, but they don't have to be. I think ultimately, many of these Adobe applications will remain the market leader in their respective niche. So that brings me to the second reason why the stock has dropped down. And it's a story that I've seen, you've probably seen many, many times before. And it's what happens when a growth company stops growing as much as they were before. If you look at Adobe's growth numbers just on the top line, they were growing, 22%, 24%, 23%. This was almost a decade ago. And, it's dropped down quite a bit, 11.5%, 10.2%, recently 10.5%. So this company that used to be growing the top line in the mid-20s year over year is now, growing 10% year on year. That's still decent growth, but you have to wonder going forward, is 10% going to become 9, going to become 8, going to become 7%? When a growth company stops growing, the multiple that the company is trading for can contract quite dramatically. In Adobe's case, this company used to trade for like a 40 or 50 times multiple. And here, when I say multiple, I'm talking about the enterprise value, which is the market cap plus the net debt. Now, net debt for Adobe, very low. So enterprise value is very similar to market cap, but I'm looking at that enterprise value as a multiple of their operating income. And that multiple, it's come down from, we said 40 to 50 to now about 15. And I've seen some people say that Adobe stock is dirt cheap because look, they're trading for, 15 times multiple, or maybe they're calculating the multiple differently and they say it's, something else. But regardless, they're comparing this current multiple to what it was trading for in the past. And they say, look, it's way lower now, therefore it's cheap. To me, this is a pretty poor way of determining whether a company is expensive or cheap. In fact, I think I made a video a few months ago called something like, mistakes that value investors make. And one of the mistakes is comparing current valuations of stocks to their historical valuations. Maybe Adobe was simply really expensive in the past. Maybe it was too expensive. Maybe 40 or 50 times multiple for this company was too much. Also, the growth rate now is lower. Do we think that Adobe with a lower growth rate now should revert back to the multiple it was trading for in the past? I would argue no. And here's a second mistake that I've seen some investors make when they look at Adobe and they say, man, it's just dirt cheap, is they're looking at the free cash flow of Adobe and they're not adjusting for share-based compensation because Adobe sure gives its employees a ton of shares. Almost $2 billion worth over the trailing 12 months in share-based compensation. That is a real expense to us if we want to buy shares, if we want to buy equity in this business. It makes a big difference. If you're not adjusting for that, then you might say that the free cash flow of Adobe right now is about, $10 billion. Well, when you adjust for the share-based compensation, it's more like $8 billion. That's the difference between this company trading for, about 13-ish times free cash flow versus about 16 times free cash flow. Pretty big difference. And as much as I like Adobe stock, and I think it's starting to look quite attractive here, a company trading for 16 times free cash flow with 10% growth on the top line, it's not really dirt cheap. On this channel, we've looked at multiple companies that are growing 10-ish% or more on the top line that are trading for single-digit multiples. Now, it's true, they often have some issues, some obvious problems. Maybe they're in countries that people don't want to invest in. It could be, a Brazilian fintech like StoneCo. It could be Kaspi, which is a marketplace payments and fintech company in Kazakhstan. An absolutely dominant business growing double digits on the top line, trading for, 7-ish times multiple. Or even just a couple days ago on this channel, I presented Supreme. I think this is a well-run, albeit very small consumer goods company. They've grown the top line compounded 15 to 20% over about a decade. They're trading for a single-digit multiple. So my point here is not that any of these companies are necessarily comparable to Adobe. Adobe is a large US tech company, very high quality, very good margins. I think it certainly deserves to trade at a premium to the businesses that I just named. But my point is, when you say Adobe is dirt cheap or it's just the cheapest stock out there, I think what you're really saying is relative to US tech or relative to the S&P 500 or US large cap growth stocks, this company looks cheap. And yes, I agree. Adobe, I think, is a higher quality company than the average company in the S&P 500. They have very nice increasing margins. They have extremely low level of debt, effectively no net debt here. And they're trading for a significantly cheaper multiple than the index as a whole. So yes, I agree. I think Adobe is attractive. But understand, I also think that the overall US market right now looks fairly richly valued. It looks pretty expensive. In the same way that I don't agree with looking at Adobe's multiple now and saying, well, they're 15 times multiple they're trading for now. It's lower than it was trading for in the past. So therefore, because of that, I think Adobe's a buy. In the same way that I don't agree with that, I don't agree with saying that, well, Adobe looks better than the other US tech stocks. So, relative to that, I think Adobe's a buy. To me, that doesn't make Adobe a buy either. No matter what, We have to put in reasonable, conservative assumptions about the future and see what does the risk reward look like for investing in Adobe stock today. The numbers we put in, they reflect a story about what we think the future of this company is going to be like. Do you think that competition is going to increase? Do you think that Adobe is going to remain the market leader? Now, for my base case, I think that Adobe is going to remain the market leader across most of the applications that they're competing in. I'm assuming they grow the top line 9% every year for 5 years. So as we said, their growth rate, it's come down. It's now about 10% year over year right now. I think it might continue to decline a little bit more. 9% is what I'm putting in for my base case over 5 years. I think that's reasonable. I'm going to assume that they're able to maintain their margins. And then this free cash flow margin here, this is representing the value of the buybacks, the money that Adobe is returning to us in the form of buybacks. And I think roughly $7 billion a year growing to $9 billion a year, I think that's actually reasonable. That's close to what they're doing now. This does represent that they're putting most of their adjusted free cash flow back into buybacks. And at the end of 5 years, I'm giving this company a 15 times multiple. Now, that might seem low. Last time I did a video on Adobe, I think I had a higher multiple here. Again, I think this is a quality business. You certainly could justify a higher multiple. I just don't like to assume too much of my growth is coming from multiple expansion. Multiple expansion requires that, market sentiment is going to change around Adobe. That might happen, and if it does, that's great. I just want to make sure for me that I'm being conservative enough in my base case. Again, you can put in different numbers. That's totally fine. With a 16 times multiple, we see here that you're looking at a 15% annualized return over 5 years. This is essentially exactly a double on the stock from the price it is today. So if our assumptions in this scenario come true, that would be, Adobe hitting a little over $600 a share 5 years from now. Now, my bear case here represents the scenario where competition really does start to eat into their growth and also their margins. They have to compete on price with Figma and all these Gen AI things out there. So I'm assuming revenue growth slows even further, only 6% growth on the top line every year for 5 years. Operating margins pull back to 32%. I'm also decreasing the amount of money that's going to be able to go to buybacks. And I'm giving this stock just a 12 times multiple. Now, this might seem extremely low and pessimistic to some people, but let me tell you, cheap can always get cheaper. I saw one video where someone on YouTube was analyzing Adobe and they were putting their multiple 5 years out from now. At the lowest, they were saying the multiple is going to be the same as it is today. That was their bear case. The multiple stays the same. And then they were looking at, maybe the multiple will go back to 20 times or 25 times or, whatever. I would encourage you all out there to not make the mistake that thinking that something is cheap cannot get cheaper. And I've been downplaying their competition from Figma and others. I've been saying I think Adobe is going to be the market leader going forward. That's what I believe. But this is the bear case. This is the scenario that's going to occur when all the critics of Adobe are right and we're wrong. In that scenario where revenue slows and margins pull back, why is the multiple not going to pull back further from where it is today? I think a 12 times multiple in this scenario is fair. And if this comes true, you're looking at a 4% annualized return, which actually for a bear case, that's quite good. For most stocks, when I'm putting numbers in for a bear case, it's not just, something that's a little bit worse than what I think will happen. It's a true bear scenario. We're simply going to be wrong about our investments sometimes. And when I'm wrong, I don't want my mistake to be devastating to my portfolio. So that's why I have conservative numbers in here. Now, as far as my bull case, I'm assuming that revenue growth doesn't decline at all. In fact, very slight uptick in growth on the top line over 5 years. I'm assuming operating margins continue to expand. 38% margins, that's extremely high. It's actually higher than this company has ever had. However, for an asset-light business that's benefiting from efficiencies of scale, I think it's possible that operating margins continue to increase. I should probably bring their free cash flow margin, the money that can come back to us in the form of buybacks, up a little bit in this scenario. So now this represents buybacks of $7 billion going up to about $11 billion here. And I'm giving this company a 20 times multiple. I mean, you can be more generous in your bull case. You want to give them, something else, 24 times multiple, whatever it is. I'm looking at, 24 to 28, call it, 25-ish% annualized return on Adobe stock over 5 years. That's essentially a triple on your money over 5 years in my bull case. Adobe stock would be $900-ish 5 years from now. I think that's very possible. And, in conclusion, just looking at this, I think the risk reward on Adobe is quite good today. 15% in my base case, acceptable risk in my bear case. I like Adobe stock. I understand why people are interested in buying it. I'm interested in buying it. Now, again, I don't own this stock currently, and for clarity, nothing here is advice to buy or sell Adobe. I just give you my opinion and I tell you what I'm doing with my money. And for me, I might sell puts on Adobe stock to try to buy it even a little bit cheaper. I try to be pretty patient when entering a position. Again, last video I said under $300, I'd be interested. I still stand by that. I'd really like if the price could drop a little more. I mean, in this $270 range, I'm looking at an 18% annualized return on my base case, where I think the numbers I put in here for my base case are reasonably conservative. So for right now, I think I'm gonna wait. I might sell puts. I haven't decided. And, you know, if the price of Adobe doubles from here, if it moves away from me and I never buy in, that's okay. It won't be the first time. It certainly won't be the last time. There are plenty of stocks that we're going to look at as investors that they look interesting, but they just don't quite get cheap enough, or they don't quite reach the number that we want. And then they double, they move away from us, and we feel like we missed out. And, you know, that's just going to happen. And it's going to happen over and over again. And that's fine. There's no company we have to buy as an investor. There's no stock I have to own in my portfolio. If we just wait and look at companies that we like, then, you know, eventually the price of one of them, whether it's Adobe or, you know, the other day we looked at, again, Supreme. I'm not buying this stock, but I said, you know, I would like to buy it at a cheaper price. If we wait, the price of some of these companies that we look at, eventually it just comes to us. So who knows, in the future, Adobe might be a stock in my portfolio. I think for the quality of the business, that Adobe is undervalued and I like the risk reward. I think it's a good stock to own. I just want to get an even better price. And, you know, I think I'll leave it here for this video. So if you got value out of the video, subscribe to the channel. If you want to join my Discord or grab my Google Sheets template here with my add-on where, you know, you can analyze stocks like this, then consider following me on Patreon. Maybe let me know if you agree or disagree with anything I said in this video down in the comments below, and I hope to see you all in another video.